Hey everyone, and welcome to The Explainer. So, what if I told you that the absolute best wealth building tool on the planet is something that most people are, frankly, entirely too scared to even touch? Today, we are completely unpacking the ultimate 10-chapter beginner's guide to the stock market. We're going to take all that complex, intimidating information and distill it down into a totally foolproof step-by-step action plan to get you started on your wealth building journey, like right now.
Okay, let's dive into this roadmap. We've got 5 key steps today. First, we'll be demystifying the stock market. Second, how stock prices move. Third, the magic of compounding. Fourth, managing risk and mistakes. And finally, your 5-step action plan.
All right, part 1, demystifying the stock market. And spoiler alert, the market is definitely not a casino.
Look, it's time to just throw away this idea that investing is basically gambling, or that it's some exclusive game just for Wall Street experts. It's really not. The stock market is actually just a structured marketplace where you buy small pieces of ownership, which we call shares, in actual real growing businesses. Think of it like this. Imagine your friend wants to open a brand new pizza restaurant, and it costs $100,000 to build. Well, she doesn't have all that cash sitting around, so she divides the business into 1,000 equal pieces, or shares, and sells them for $100 a pop. If you buy 10 shares for $1,000, boom, you now own 1% of that restaurant. Now, if the restaurant takes off and becomes worth $200,000, your 10 shares, they're now worth $2,000. You literally doubled your money just by owning a small piece of a growing business. Now, just swap that local pizza place with Apple or Amazon. That's the whole shebang. That is the stock market.
Moving right along to section 2, how stock prices move. We'll look at the basic building blocks and market cycles here.
So, now that you know what the market actually is, we need to talk about what you can actually buy and why those prices bounce around every single day. What's really interesting about this is how easily you can categorize your choices along a simple risk and reward spectrum. First up, you've got individual stocks. That's buying a piece of a single company. Now, this is high risk, high reward. If that one specific company goes under, you lose big. Next, we have ETFs and index funds. You can just think of these as a giant basket holding tiny pieces of hundreds or even thousands of different companies. Because your money is spread across the whole market, it carries a medium risk with a medium to high reward, which makes it incredibly beginner-friendly. And finally, there are bonds. This is basically just you lending your money out to a company or a government in exchange for interest. That's your safe lane. Very low risk, but also very low reward.
Okay, so why do the prices of these investments constantly go up and down? Well, aside from basic supply and demand, it really boils down to 3 main factors. First, company performance. Are they actually making money and growing? Second is economic news, so things like inflation or changing interest rates. But look closely at that third point, sentiment and emotion. While earnings and economic data make sense logically, it's actually mass psychology, specifically fear and greed, that often drives the biggest, most irrational swings in the market. In fact, a lot of experts say the market is driven 10% by logic and 90% by pure psychology.
And that emotional roller coaster perfectly explains market cycles, which we can contrast right here. A bull market happens when prices are rising, everyone's super optimistic, and money is just flowing in. Picture an optimistic bull thrusting its horns upward. A bear market, on the other hand, is the exact opposite. That's when prices drop 20% or more, fear completely takes over, and you see widespread panic selling. Think of a fearful bear swiping its paw downward. But here is the thing you absolutely have to remember. Both of these cycles are completely 100% normal parts of a long-term investing journey. In fact, I need to emphasize this point because it is so absolutely crucial to disarm those deep-seated fears. Every single bear market in history has been followed by a recovery. Every single one, without exception. Whether we're talking about the 2008 financial crash or the big drop in 2020, the people who let fear take over and panic sold, they locked in their losses. But the people who took a breath and stayed the course, they came out way wealthier on the other side. As the old saying goes, time in the market completely beats timing the market. All right, on to section 3, the magic of compounding, where you'll see why time is truly your greatest asset. If our goal is to build wealth, you can think of compound interest as your ultimate hero's sword. Albert Einstein famously called it the 8th wonder of the world. And honestly, once you see the math, you'll totally get why. Compound interest just means that your money makes money, and then, here's the kicker, those returns go on to make even more money. It is literal exponential growth working for you while you're fast asleep. Let's move to a real-world scenario and see how this builds. We've got a pretty dramatic comparison here.
So meet early Emily. She starts investing at age 20. She puts in $200 a month at an average historical stock market return of 8%. And she does this for 40 years. Then we have late Leo. He uses the exact same strategy, the same $200 a month, the same 8% return, but he waits until age 30 to start. So he's only investing for 30 years.
Now fast forward to age 60, and this brilliantly illustrates the math. Emily ends up with over $700,000. Meanwhile, Leo is sitting at under $300,000. Emily has more than double Leo's wealth simply because she had a 10-year head start. The math absolutely proves that time, not some magical stock picking skill, is the real secret to building wealth.
So, what is the best strategy for a total beginner to actually capture that kind of growth? Check out this formula: passive index investing plus dollar cost averaging. A passive index fund means you aren't trying to pick the next big winner. You're just buying a tiny piece of the entire global stock market. And dollar cost averaging, that just means you invest a fixed amount of money every single month, regardless of whether we're in a charging bull market or a panicking bear market. Get this, over 80% of professional, highly paid fund managers with billion-dollar budgets actually fail to beat a simple, boring index fund over a 10-year period. No way, right? So don't try to outsmart the math. Just let a simple, automated global index fund do the heavy lifting for you.
Next up is Section 4, Managing Risk and Mistakes, because we definitely need to talk about how to protect your money. Naturally, there are some dragons and pitfalls on the path ahead. Let's rapid fire through the 5 biggest beginner mistakes you absolutely have to avoid. Number 1, waiting for the perfect time to invest. Spoiler, there isn't one, and every month you wait just costs you compounding growth. Number 2, checking your portfolio every single day. Don't do it. It just triggers anxiety. Number 3, trying to pick hot, trendy stocks instead of sticking to those reliable index funds. Number 4, letting fear and greed drive your choices. And number 5, this is the big one, not starting at all. Let me be clear, doing nothing is not playing it safe. Because of inflation, holding cash is basically a slow leak on your purchasing power. You're just quietly losing money year after year. So how do you protect yourself? What's your shield? The number 1 tool for managing risk is diversification. This just means you spread your investments out across thousands of different companies to offset any potential losses. Think about it. If you put all your cash into one single company and it goes bankrupt, you lose everything. But if you buy a global ETF that holds thousands of companies and one of them fails, well, you still have hundreds of others that are growing and working hard for you. It's the ultimate protection against catastrophic loss. All right, we've made it to Section 5, your 5-step action plan. Let's talk about how you can actually start today.
This is it, folks, the climax of our explainer. A fast, undisputed, foolproof roadmap to finally get you off the sidelines. Here are the exact 5 steps. Step 1, build your foundation. You absolutely need 3 to 6 months of living expenses saved in an emergency fund, and you've got to wipe out any high-interest bad debt first. Step 2, define your goals so you know what your timeline and risk levels look like. Step 3, choose a tax-advantaged account, like an IRA in the US or an ISA in the UK, on a regulated platform. Step 4, pick a broad, low-cost global index ETF. And finally, Step 5, this is a real game changer. Automate your contributions. Just set it up so your money moves straight from your bank into your investment account every single month, totally automatically. It completely removes human emotion from the equation and forces you to build wealth consistently.
Before we wrap up, let's just briefly recap the core principles from this 10-chapter guide. These are the mindsets that truly separate the wildly successful long-term investors from everyone else. You need to think in decades, not days. When the market inevitably gets a little choppy, stay the course. Keep it simple. Never stop learning. And above all else, start now. Because the brutal truth is, every single day you wait is literally costing you compound interest. The math proves it. So I want to leave you with this final provocative thought. What is your very first step going to be today? Are you going to set up that emergency fund, finally open a brokerage account, or maybe automate your first transfer? Whatever it is, stop waiting. Make a plan, take action, and hey, let me know in the comments below what your first step is going to be. Thanks so much for joining me on this explainer, and let's get building.